Good morning, and my name is Gary O'Connor. I'm the CEO and President of Moneta Gold Inc. We're a gold exploration company based in Toronto. Our focus is the Timmins area. We have a major project, the Tower Gold Project in the Timmins Gold Camp. I'm a geologist. I'm a veteran of the industry, 38 years of international experience, working on many large development projects around the world. And we've just released our PEA study on the Tower Gold project, had excellent results, and we're really happy to be able to, to present those to our stakeholders and all those interested.
Gary, thanks for joining us. Appreciate that. First time we've met or spoken, and I think what we'll try and do here is, because you've kind of got some good news in the sense of this PEA numbers are quite attractive. Maybe give us the headline numbers there, and then what I might do is kind of sort of backfill it the story by trying to understand where you've come from and how you've got here, and then maybe we'll move on to what you're doing next. So when you give us those headline PEA numbers, and I'll go from there.
Yes, I know. Excellent, thanks. The PEA showed a very robust, sound gold project. It has an NPV of 1.07 billion Canadian dollars, an IRR of 31.7%. And this is all done at a US gold price of $1,600. The project shows 261,000 ounces production for the first 11 years. It's a combination of both open pit and underground operations. The average grade for those first 11 years is 1.3 grams per ton. Fast payback. We do a 2.6 year payback, and it has an annual cash flow of over $100 million. And just under 2 billion life of mine cash flow.
And yet only 119 million market cap. So I guess people are waiting to see what the economics look like. So you pleased with the economics?
Yes, we are. It's very robust. It's something we can manage. The initial capital is only 517 million Canadian. We schedule the project such that many of the large capital items come in over the course of the project. They're not upfront. It's something we can fund, something we can raise the money for. We have the ability to do that, and it has a size which is going to be very attractive to investors.
It's very attractive by investors. I think you mean strategic investors or industry partners. So plus 250,000 ounces a year is very attractive indeed. But are you mine builders? Are you operators yourselves, or are you setting this up for someone to kind of walk in and take over using their balance sheet?
Well, we've actually put a team together that can deliver this project. Jerry Rogers is a veteran. He's of my era. He's built and operated mines. He's all around the world. He's our VP projects. Jason Dankowski has just joined us. Vince Deschamps is the Director of Sustainability, and Jason McIntosh is our CFO. So we actually have a team together. We feel we can put this into production. We can build it, and we can develop it and then operate it. Of course, we will need more, some more key appointees as we move forward, but we have the foundation, and it's a very good foundation.
Right. I know you're setting up to build it, but there's this kind of competitive tension game that's played where you've got to look like you're going to be able to attract someone to come in and take you out. So is it a realistic assumption that you will get into production? That's what you would advise your shareholders to let you do?
Yes, we would. We feel we can do it, but look, we're a public company. We're subject to the market, and it is possible that someone could take us out. There's been a significant amount of M&A activities in our area. Everything from Newmont acquired Gold Corp. Recently, Agnico Eagle acquired Kirkland Lake Gold. Kirkland Lake Gold had previously acquired St. Andrews. There's been a lot of M&A activity, so there's every likelihood that may happen. But the way we have to approach anything is to move ahead like we can do it ourselves, and we feel we can. And subsequently, that's why we put together a project that we can fund, we can build, and we can develop. So and it's of a size that is going to be of interest to many investors.
Well, absolutely. So here's the thing with the current economic climate as it is, we've seen companies after company put out economic studies where the capex numbers are being blown out of the water because inflation is driving that. Access to good staff, being able to hire people, quite frankly, is driving that. Lots of reasons it's going up, and people are resistant to put out economic studies. So I guess two questions. It's a two-parter, Gary. First is, were you tempted to delay the putting out the PEA? And secondly, given that kind of economic inflationary background, are you tempted? Would you not be more tempted to make it someone else's problem, as it were, and just work your way through the phases and let someone else's balance sheet take that hit?
Look, our role here in this company is to add value to the shareholders and stakeholders. Our role is to, and by doing that, it is to move the project forward. We did, we looked hard at the inflation issues we're having recently. However, we think we've covered those. If we'd put this project out 6 months ago, a year ago, it would have been, at a lower capital cost. We probably would have built the project differently, but we approached it in a manner that we took into account inflation. There's contingencies there. We used a conservative gold price. The project is still very robust down to $1,300 gold, where, we don't see any real major risk here in moving it forward. And by de-risking it and moving it forward, we add value to our stakeholders, and that's really our job here. So to delay things would have just really delayed some key milestones in developing and moving the project forward. We are a public company. We're listed on the main board of the TSX, so we are subject to the whims of the market. So it is possible that someone does acquire us. Look, there's been a lot of M&A activity in the camp, everything from Newmont acquiring Goldcorp to Kirkland Lake being acquired by Agnico Eagle, who previously, Kirkland Lake had acquired Detour, and prior to that, St. Andrews Goldfield. So this is an area, it's a great location. It's in a great jurisdiction. So it's a sought after, area to have a major project. We've now put that major project together and moving it forward. Our team is able to deliver it. We have the basis there, we have the skill set, and we will add to that team. But we're prepared to put this project into production. We can now fund it. We've developed a project here that we can fund ourselves, so we do not need to be taken out or acquired. However that may happen, we can't make any promises there.
Right. Okay. But just on the specific component about, do you think the PEA gives enough confidence, given the economic backdrop, that the numbers won't start, the numbers won't start being affected, in the sense that we've seen, in the market, lots of very marginal projects just, really struggle in that background? Do you feel that where you're at with I know these are PEA plus or minus 30%, it's a tough one until probably you get through the next study phase, but do you feel confident enough about what you're seeing with the ore body in terms of your ability to extract the value from it?
Yes, we used a large engineering firm who has an up-to-date database. They are currently building a number of projects, not only in Canada, but around the world. So they have a very good feel of where the costs are. We went away from using a smaller boutique engineering firm. We use an actual engineering firm that does EPCM contract work. It's done probably the only fixed price contract in Canada in the last 20, 30 years. So this is a group that can deliver, it can build. We did take into account, the inflation that hasn't occurred. We feel we've covered it for the current time. The project is robust, so at even much significantly lower gold prices, down to, $1,200-$1,300, the project is still, robust and can be built. So we think we've covered those, possible cost increases, and we have a project here that is flexible enough in its development that we could, easily make more changes to cover any possible increases. Remember, we're operating at $910 cash cost. It's $1,073 all-in sustaining costs. We've shown we can easily pay back our capital 2.6 years. So, there's a lot of robustness in this project, which is a result of all the hard work our team put into in putting the project together.
Okay, well, let's look at this. I think you would argue a slight disconnect, because, sub 200 million for what the numbers you were talking about, the production, the payback period, the AISC. There's probably a slight disconnect, you'd argue, because when you put the PEA out, albeit only a couple of days ago, not much of a reaction in the marketplace. Was that a question of they're expecting more, or is it just a risk off out there?
I think we just created a liquidity event. The gold market at the moment is struggling a little in the way of equities. The price is still quite robust. We're over $1,700 gold. That's significantly higher than we did our base case at. So, the majors and mid-tiers are cash flowing well at the moment. They're all cashed up. So $1,700 gold from a operating viewpoint is very good. Somehow the market, there's a little disconnect. It's all because of, we know there's wars going on in the world. There's inflation. So there's a lot of uncertainty. People are flocking to US dollars. But from a gold viewpoint, this is an environment which is going to be good for gold. Inflation is generally good for gold, and we'll see that probably kick in as we move forward. And we've got a project here now that's extremely robust, something we can fund, and we don't see a lot of downside risk here for the company.
Okay, so because what I'm trying to work out is there something I'm missing here? Has there been issues with metallurgy? Has there been issues with the project in any way, shape, or form before? I mean, historically?
No, there hasn't. Metallurgically, it's very good, actually. All the sediment-hosted gold, high carbonate content, low sulfide. It's environmentally very, very sound. No deleterious elements, no acid rock generation. We used a conservative recovery rate. We see good recoveries. We don't have to fine grind. We're located in a great location, immediately adjacent to a major highway. We're only 100 kilometers east of a major gold mining camp, Timmins. That is Canada's largest, most prolific gold mining camp. So we have location, jurisdiction, and I think it's just part of the overall market that there's upside here for the potential investors to gain by investing in us. And we see this as a good opportunity to get the story out.
Is there kind of catch-22 going on here, Gary? Because people are looking at your capex and going, well, actually, in relation to your market cap, that's pretty punchy. So they're not investing. Whereas if we can drive your share price up, that ratio gets smaller in a way. It seems.
Yeah.
You're in a tricky position. But what do you do about that? How do you people? What do you think people need? I'm talking about retail or family offices, not industry. Okay. Not some mid tiers or majors looking at this, looking to get their reserve numbers up. But what should retail and family offices be looking at when they look at your project and thinking?
I think they just look at the basic underlying valuation, where we've got nearly a $1.1 billion project here. It's very good upfront capital. It's something we can fund. There's lots of upside here for investors. And remember, in just the last 3 years, we've gone from being a $30 million company to a $200 million company. And so, there's still plenty of runway here for us to add, at a 50% discount to our, the NPV of the project. We're looking at, nearly $600 million. So that's three times what our current valuation is.
Okay, well, but it seems to me, and again, based on questions sent in, et cetera, and obviously looking at many of these things myself every day, you say we can easily fund this. So tell me how that breaks down with a company like yours from the starting base of where you are today. Why is it easy to fund?
There is the ability to debt, to mezzanine. There's gold loans. We have no royalties on the majority of our ounces. There's lots of ways we can fund this. We can go to the market, equity. We can bring it to strategic. This is not these are not big hurdles for the company. We've just raised a significant amount of money recently for our current pre-feasibility study work, which we're now embarked on. So we're well on the way to doing some of the drilling for that pre-feasibility. We've completed over 60,000 meters. So yeah, we're moving this project forward, and we've shown the ability to be able to fund it, and we don't see any issue in doing that moving, in the future as well.
Right. So you did it's almost like you did the raise sort of back to front. Wouldn't you have been expected to put out the PEA, bathed in the glory and sunshine of how people reacted to that, and then raised money at a better valuations, less dilutive? So do you think that people are saying, well, maybe we suspect there might be something wrong with the PEA because you raised the money before?
The original plan was to raise the money after the PEA. As you've seen in the market, there's been a number of PEAs and PFSs put out this week, and you've seen mixed reactions to those. Sometimes the market, doesn't always react well to them. We put a large resource update out earlier in the year in May, generally the market reacts well to the resource update. We put that out. We had a good reaction. So when there was a bought deal funding presented to us, it was at very good, attractive terms. It was on a charity flow-through basis, which gave a big premium. We took the money then because there's no guarantee when we put the PEA out that the share price would go up. And yesterday we came off slightly. There's a bit of a liquidity event. People sold into it, but we've now shown that, a significant upside valuation for the company. So we think that'll be corrected. So, in this industry, when there is a good deal brought to you, it usually makes sense to take it. So we did, and it enabled us to continue drilling, to do our PFS drilling. This is all about de-risking. It's about upgrading the category of the resources. It's about moving into the pre-feasibility study, which we're now doing, and we'll continue to do that. We've got a lot more work to do. There's hydrological studies to do. There's geotechnical work, more metallurgical test work. There's a lot of technical studies. We've also got, of course, the environmental impact baseline work going on, the community engagement. So we wanted to keep all of that going, and we had some very good investors wanting to invest, large US precious metals funds who currently, who previously were not shareholders. They invested and they saw the upside here, and we now want to get that message out to the to the retail audience and to the market, so that they can also see the upside that these large precious metal funds also saw.
Right, and if I look at some of the conversations I've been having the past couple of weeks, and I think one that springs to mind is the Asino, one of the Ross Beatty's investments, where they put out a PFS, market went, so what? And they made the decision and say, well, if that kind of news is not going to get the market going at the moment, we're kind of downing tools. We're going to stop drilling. We're going to move to desktop studies, and that's it until the market actually starts behaving the way we can predict. You, on the other hand, have raised a bunch of money, so I guess, and flow through that. So there's an expectation that you're going to have to get on with it. Is that the case?
That's correct. We've continued to drill. We've continued to do the resource infill drilling. This is all part of the pre-feasibility, converting the inferred to measured and indicated. So we're continuing to do that. We're continuing the baseline. We'll continue some of these key studies as part of the pre-feasibility study. Look, the market, the gold price is good. The environment for gold is good. Yes, the market's a little fickle at the moment, but it can change, and it can change quickly, and we will be ready for that. We'll be in a good position to benefit from that. We've shown the great valuation we have here. High NPV, a good IRR, fast payback, good operating costs, all-in sustaining costs. So we see ourselves as being poised to benefit when the market does turn. So I don't think we're in a position really to want to wait and down tools. There's value to be added here for our shareholders and stakeholders, and we've got the team in place to do that now. So we're going to push ahead.
Well, given the size of the resource and that you put out previously, in terms of all categories, it's big. It's big enough. So for you, the best bang for your buck, the most efficient way to spend your money is on the infill drilling.
At this stage, yes. To complete a pre-feasibility, we cannot use inferred. We have to use measured and indicated, and we actually have a significant amount of upside in our current, it's our PEA mineable resource. We have areas within the pits that have not been drilled out. They're currently deemed to be waste, so we are drilling those out. There's areas in the pits that have high grades that are open in certain directions. We're drilling the extensions of those, again, to get the grade up. We're going to target the underground. Remember, in this PEA study, we only have the 10 years of full production underground. We're looking to extend that because the underground provides us high-grade ounces, and we're able to mine those. Bulk tonnage underground means long-hole open stoping, so that provides good cheap ounces at a low production cost, and it brings up the average grade. Our per unit cost benefits significantly. So we're going to target all of these areas in regards to adding more value as part of our PFS, and that will actually add more value to our current baseline, PEA that was put out. So there's significant upside here to add value. I should also mention, by expanding the production from underground, we will add significantly to the current project valuation. The more high grade we put through, so that's going to be a key item we're going to focus on. Remember, we only have production out of Westaway and Southwest at this stage. We do have underground resources from other projects, other deposits, notably, the Garcon area at Garrison. We also have the ability to look at doing an expansion. We could look at expanding once we've paid off capital. We could make the project larger, but at this stage, we're going to be looking at a number of other key areas of reducing capital. There's the site optimization that can be done. There's the issue of using, dry stack tails rather than building a tailings management facility up front. So there's a number of other ways we can add, reduce capital and add value to the project.
Right, and just in terms of, I've forgotten about the O3 connection here. Do they have a board seat or not?
Yes, they do. They have 2 board seats. So O3 does own a 24% of the company. They've been very supportive and they've been very good shareholders, and they're looking, to the long-term, development of the project. For them, it's key. We've added a lot of ounces to their portfolio, and we've added significant value to them as well. So they've been very happy.
Right, they're very happy in the sense that they're not. You would not consider them for 1 second as an overhang to this. And should people view them as a potential overhang, or, as you say, supportive shareholder?
Yeah, they should look at them as supportive shareholders. Look, Jose said a number of times that they're in the business of adding, precious metal ounces, gold ounces for their shareholders just by having that strategic investment in us. They've done that, in loads and spades. They've really added a lot of, ounces to their shareholders and value. So we'll continue to do that for them, and they've been very happy the way it's been going ahead.
Right, and with regards to, again, your institutional, the rest of the institutional shareholders, of which there are many, 40% of your share register is institutional. Are you under any pressure from them to perform a certain way? Because again, people tend to sort of flip-flop around their preferred strategy when times get tough, or are they happy with the plan that you've got and the strategy that you've got to deliver that plan?
Yes, we feel they're very happy with the strategy we've got. Remember, we've got most of North America's largest, precious metals gold funds are our shareholders in us. They look long term. These are people that are not looking to, to do day trades. They're looking long term. They're looking at the big picture. They see a major gold project here in North America in an excellent jurisdiction, key location. It's a great location. We're right beside the highway in a well-developed mining camp, very skilled workforce, all within driving distance, operating mines all around us. So they see this as being a project that's going to be well sought after and be well backed. So they can see how we've managed to grow it, how we've increased our value. As I mentioned, we've gone from a 30 million market cap to 200 million market cap, and just in 2-3 short years. And they see that we have had the right strategy in moving forward. We've now put a PEA which has delivered on that strategy. It's something we can build and has significant value to our shareholders and significant upside. And it's something that we can expand on, if should the need be. But at this stage, the development strategy is a staged one. We start with some high-grade open pits. These are in areas that have already been mined. There's already open pits there. So these are brownfield areas that have been historically mined. Low strip ratio, outcropping. We start there with good grade. We develop the underground. That brings in more high grade. It lowers our per unit cost, and we move forward. And we have a very good strategy of then, developing the Golden Highway pits after the Garrison ones, and then continuing to, mine underground. And as mentioned, we're looking to expand that underground resource. We have significant, intercepts and historical drilling that shows there's a significant upside in the rest of the camp and adjacent to our current resources. And we also have the ability to expand, the throughput, expand the plant, and we'll look at that as we move forward. That way the project can grow and add significantly more value. But we feel it's very robust, and our institutional shareholders have been very supportive of the way we've moved forward. Many of them came back in on the recent raise. They increased their positions. We brought in new large, gold investment funds out of the US. They liked our strategy. We went through it in detail. And so they're there for the long term. They're not, none have been selling off. They've been adding to their positions. And so they're very happy, and we're happy to have them as shareholders.
Right, and when you look at the market now, like even producers have been hammered. Right? Everyone's feeling the effects. Even producers have been throwing off cash, are getting hammered. Some down 50%. It's going from billion-dollar companies down to $500 million companies off the back of sentiment in the marketplace. Does that again affect or drive your thinking about the speed to market? Big is better. I'm just trying to work out with the conversations at board how agile you are, or how aggressive you are, or what your intent is, and how you react to market conditions like these.
Yes, you're right. The market is very fickle at the moment. People are looking for opportunities to move into cash, to sell any equities. So even good performing companies, if there's something that provides a liquidity event, and we think that happened, when we put the PEA out, there was good selling into that. People are looking for rush to cash, but the market is very fickle. It can come back very quickly. Gold is still at a good price. The conditions are a good price. However, we do keep an eye on it. Look, we could have put together a project 3 times the size. So you'd be looking at something, $2 billion capex up front. We could have had everything front ended, so we could have been at $2-3 billion, starting everything from day one and having big initial capital. But we didn't think the market is there for that. The development costs of that are significantly more. So we put together a project that really optimized throughput. It optimized the reduction in capital, and it staged the capital and development such that we can fund it, and we don't need big capital requirements up front. In the current market, inflation is a major issue, and we have to keep an eye on the capital costs. So we feel we've done that with our development strategy and showing it's over $1 billion NPV. 37%, over 31% IRR, and a 2.6 year payback. So and a good cash cost. So these are all good, good sound basis to move the project forward. And as mentioned, we do have significant ways we can add value on the current project, just with some of this infill drilling, some of the optimization, and development of the more underground, and development of more high-grade ounces at surface, as well as filling those pits, reducing the strip ratio, and adding more ounces into the current mine plan.
Well, Gary, I appreciate this. Is the first time we met or spoken, and the first time I've heard this story, other than in passing from Jose at O3. He seems quite pleased with what you guys have done over the past 2 years. So it's about time he came on. So that's good news. Sounds like
thank you.
Well, you've got a lot more on your plate. You've got some money to do it with. So stay in touch and let us know how you get on, okay?
No, excellent. We'll see. That's my point before. So you hadn't heard of us. So this is something we have to address. We need to get that word out. And so obviously we're a hidden gem there for investors. And we'll get the word out to more investors and to the market. And we need to get that buy-in as we have in the past, and continue to add value to all our stakeholders. So, yes, so thank you.